Stocks are on fire, as they have been since March 2009. It brings to mind the Rage Against the Machine song, Bulls on Parade. It's right now we're at a case where investors are just very excited about where the U.S. economy seems to be heading. Yeah, it's not great, but at least there's improvement. The worst seems to be over. The Fed is keeping rates near zero. There's a lot of easy money policies that are helping to spur growth. But of course, there are a lot of skeptics as well who wonder if this is going to end badly, whether or not we're inflating another bubble that's just going to burst just as it did with the real estate bubble and the Great Recession that followed. So is the market running out of steam? As always, a lot of bears among the buzz readers. Jack Milton is one. He says easy money is the cause of the bubble and the crash that happens aftermath. Recession and paying off debt is the fix, but as the government delays recessions all the time, it sets us up for a depression. It is going to end and the crash will go into the books, just like Tulip Mania, South Sea Bubble. This is yet another financial mania. Obviously, I hope he's wrong. We have, though, had many examples in the not-so-distant history. We had the tech bubble, obviously, in the early part of 2000. We had the real estate bubble that I've already mentioned. So, unfortunately, there is definite reason to be worried that what's going on right now is possibly another bubble. Mickey Jackson agrees. We have played every card in the deck to avoid facing logical solutions to our extensive economic problems. Our U.S. leadership has invented the most imaginative and convoluted scams to avoid the inevitable devaluation of our dollar. No logical explanation can justify this unsustainable improvement in the economy for much longer. It's certainly a concern. We can't keep kicking that debt can down the road forever. I do think, though, that many readers are a little bit too overly alarmed, and that, it's their right, of course. But Paul Hank is even more bearish than the preceding two readers. This is a deflationary crash. Stocks are a bubble. Bonds are a bubble. Housing is a bubble. We have not seen the bottom in March. He's referring to 2009. Be careful in your 401ks. Cash will be the only place to be for a short while. There is no place to escape. There is no place to diversify. I think he has some legitimate points. You do have to be worried, particularly I think with bonds more than stocks, about what's been going on there. But I'm not so sure that there's no place to diversify. That seems a little bit overwrought, and I do not see this kind of looming depression. There is, fortunately, one bull out there, for what it's worth. Daniel Nixon writes, every sign we have as far as the economy goes screams grow. The dollar is strong, inflation is low, money purchasing power, credit, is cheap, but the attitude of the consumer can kill anything. The math is alarming. The people are so afraid of inflation, in part due to an overwhelming level of misinformation, fear-mongering, and poor analysis surrounding quantitative easing. I do think he raises an interesting point. There is a lot of just this hype and this rush to criticize the Fed because QE2 may wind up creating some inflation down the road, and that may in fact be true, but we do need to fix the short-term problems with the economy. We do need to get the GDP heading higher. We need to get the jobless rate heading lower, and clearly the Fed needs to do something to try and get the economy back on track instead of just sitting idly by. So I think that definitely there are some people that are getting a little bit overly alarmist about Fed policies and what that's going to mean for the long term, because you do need to fix the economy in the short term, and that will help the stock market probably head higher if you do have that economic growth.